Hi guys, my name is Manu and welcome to another episode of Sweet Money. Today we're going to talk about your favorite topics: properties, estate planning, and taxes. Do you own a primary residence? Do you own investment properties? Do you want to know the ins and outs before you get into a property? Or do you want to leave your properties for your children who haven't called you in a month? Or maybe you just want to know the tax implications. Or better yet, maybe you want to save a little money on the taxes. Whatever it is, let's get to the bottom of things. So as we chat, I want you to keep one thing in mind. There's a massive, major difference between tax exemption and tax evasion. Tax exemption is when the government grants you a break on your taxes. Tax evasion is when you decide to give yourself a little break on your taxes. And by the way, tax evasion is illegal. If you deem your property as your primary residence, that property is then exempt from taxes. However, you have to adhere to certain rules in order to maintain that primary residence status. So let's talk about those rules. Number one, if you make major renovations, you cannot claim the expenses as business expense. The CRA will deem that a significant portion of your house is being used for business purposes. Number two, you must live in the house for at least 1 year before you sell it. Otherwise, the CRA will deem you are flipping the house to earn income. Number three, some exemptions to the principal residence may apply. For example, death, disability, relocation for a new job, divorce, birth of a new child. However, if you relocate and rent the house, then a few years later you come back and start living in the house, you will have to pay taxes on the increase of the fair market value during the period that you were not residing in the property. If you pass, your primary home will transfer to your spouse tax-free. If your spouse passes, then that primary residence will transfer to your children tax-free. In Canada, there is no gift tax. I know this is an awesome tax exemption. However, there is a twist, and we'll get into this twist as we talk about estate planning. So hang on tight. At the time of death, the investment properties transfer to the spouse tax-free. And at the time of death of the spouse, the investment properties transfer to the children. However, there is a capital gains tax implication. In addition, while you're alive and you decide to sell your investment properties, you are still faced with the burden of capital gain taxes. If the capital gain tax wasn't enough, you also have to declare your rental income and your eligible rental expenses. Your accountant will fill out a form called a T776 Statement of Real Estate Rentals. And then your rental income or loss will be applied to your worldwide income and it will be taxed at the marginal rate. And by the way, the government is fully aware of how many investment properties you have. So don't even think about it. As of June 2024, thanks to my homeboy JT, capital taxes have gone up. And homeboy's finance minister, Freeland, who doesn't have a background in finance, if I may say, believes that less than 1% of all Canadians will be impacted by this rule. Only less than 1%. But that's not the case. And let me show you a very basic example of how it affects many Canadians. Now, for example, if you bought an investment property for $700,000 and a few years later you sold it for $1.2 million, you now have a capital gain of $500,000. According to the new rules, you get a 33% exemption on the first $250,000, which means that 66% will be taxed at 50%, which is $82,500. The remaining $250,000, you get a 50% exemption, which means 50% of $250,000 will be taxed at a tax rate of 50%, which is $62,500. So your total tax bill is $145,000. $25,000. In case you're wondering, my boy JT is responsible for an additional $20,000 of taxes so that he can fund his family vacation to Jamaica. I don't know about you, but I don't like it when people take 20 G's out of my pocket for no apparent reason. Now let's get into some finer details of estate planning. As I mentioned to you earlier, when the primary residence of your parents gets passed down to you, you receive it tax-free. However, if you already own a house and you're getting this free house through the estate, you cannot simultaneously declare two homes as your primary residence. It's only one. Now, what do? Either you sell the house effective immediately, so you avoid the primary, so you avoid paying any taxes, or if you rent out that house and make it an investment property down the road, you will be subject to capital gains tax. So when we say that the house is tax-free, it's only tax-free in the event that you sell it. Estate planning is like the ocean. It's almost never ending. And you can literally make hours and hours worth of videos. So for the purpose of this video, I'll touch on a few minor things here and there, but I do recommend you speak to your accountant so that he or she can build a program that works best for you and your situation. A TFSA is money you can put into a registered account. It grows tax-free, and whenever you pull it out, there's no tax implications. And as I told you earlier, there's no gift tax in Canada. Therefore, if you've been putting in money into your TFSA diligently year after year after year, you decide to pull that money out, you can now gift that money to your children and there's no tax consequences. A third item which can be distributed tax-free between yourself and your children is insurance. Let me share a little secret with you. Kryptonite kicked Superman's butt. Insurance kicks the taxman's butt. The wealthy and the ultra wealthy weaponize the insurance as a tool to minimize their taxes. Whereas the common person views insurance as an expense. And that's the difference between a sheep and a wolf. Insurance proceeds are tax-free regardless of who receives it, whether it's a corporation or an individual. In addition, insurance policies are also taken to pay off tax bills at the time of death. You may or may not know this, but when your assets are transferred onto someone else, there's a 54% tax rate in Ontario, which includes your federal tax, provincial tax, and your probate tax. There are insurance products which also pay out dividends, and these dividends can be used during your retirement to partially or fully fund your retirement. And yep, you guessed right. These dividends that you receive are tax-free. And in addition to that, there is always a premium at the end, meaning that when you pass, someone will get a lump sum of money upon your death, tax-free. Now, I know you guys are getting very excited by some of the things that I'm saying, but this is the part of the program where I need you guys to pay very close attention. So listen up. Those who sell products for a commission have incentives to sell certain products over other products. Therefore, it is very important before you buy any insurance product, speak to your accountant. Figure out which insurance product works best for you and not for the insurance underwriter. Some of the factors that help determine which insurance product is right or wrong for you are the following: the size of your investment portfolio, your tangible assets, whether or not you own a corporation, whether or not you want to leave a donation for a charitable organization, whether or not you want to leave money for your children. And there are many other variables that come into play. And all of these variables help determine, again, which insurance product is right for you. In addition, what might come as a bit of a surprise to you is that insurance policies can be modified to cater to your needs. But once again, I've said it before, I'll say it again, you need a good accountant to sit down with you and go through your financial situation and what your requirements are down the road so that you are well taken care of. In addition, it is also worthwhile for you to get a corporate lawyer to go through the T's and C's of the insurance policy so that when you're no longer there, you don't want your loved ones to be left standing there with an empty bag. And remember, this all starts with a simple conversation.